Good evening. So as Jake mentioned, I am Anna Carlson. I am a byproduct of the founder and his wife. I've been with the firm for around 1 decade. I've been under that man's tutelage for a little over 3. And he's been in the financial services industry for about 35, 36 years. He began in corporate finance. Fast forward to in January of 2008 was when he made the decision to move from corporate finance, banking, different things like that. He moved from corporate finance to individual finance and financial services, financial planning for individuals in January of 2008, which, if you look back, that was probably the worst time, unbeknownst to him at the time, but the worst time to make that career shift. But nonetheless, he did that. He worked with Mass Mutual at first and worked for another large firm for a couple of years. Fast forward to 2012. He had sort of had it with the large firms, and 2012 is when we were incorporated, sort of the want something done right, got to do it yourself. The 2 key things that really bothered him about the large firm companies, the large firm financial planners, advisors, was number 1, their main objective was to always, it was hammered into him as an advisor, was to never lose a client. No matter what, you never want to lose a client. You never want to have a bad conversation with a client, which what that meant was in your investments, keep them very mediocre, middle of the road, subpar, so that in big drops, they're not panicking and calling you, and why is my account down 35%? But in the same token, in the highs of the market, you read about or hear about the S&P 500 going up 22% this year. I look at my accounts, I went up 8. I'm like, what's going on? It's because, again, the objective is to keep you as a client, to keep you content, never typically happy, but never disappointed or angry enough to leave. He couldn't stand that, right? He wanted to be able to invest his clients how he felt was the best method per their financial plan or per what they needed, their timeline, just a bunch of different pieces to a retirement puzzle, right? Which leads me into the next issue, which was the actual planning. So he worked for a company that did tout their efficiency in being great financial planners, specific to retirement, but realized they never really made actual retirement plans. He did have a plan. He had an advisor in his mid-30s that drafted a financial plan for him for his age. So it was from 35, 36 years old to retirement. It was about 120 pages thick, spiral bound. He took one look at that thing, and I think it collected dust for the next 15, 20 years. It meant nothing to him. It was all full of charts, graphs, Monte Carlo analysis, with the line, with the dots so close and so far. He could not stand that, so he wanted to ensure that our plans were clear, concise, and they are on one page. So you have a snapshot plan. You don't have to go to page 28 to see what was I able to spend again, and page 46 to see what was I going to be bringing in Social Security, and start at page 80 to see the different rates of return. No, ours are on one page, and what they're going to show is every year from today's age to the end of retirement, exactly what I'm going to be bringing in every year, well, an estimated amount of what I'm going to be bringing in every year, what I'm going to be spending, and then what I am going to be short or plus in retirement. Meaning, when you're still working, you typically have an excess of income. Let's say you're still going to work for another 5 years. That's 5 years where you have more money coming in than you're spending. That's why you're able to save into your 401ks, your savings accounts. But generally, when you go to retire, right, the opposite thing happens, and now I have more expenses than income. So I have to draw from my nest egg. That's what I've saved up this nest egg for. Party foul. Sometimes when a phone goes off, I'm like, oh, was that mine? You're good. Easy mistake. Where was I? Oh, so in retirement, we've built up this nest egg in our working years, and in retirement, what we draw from that nest egg, that's going to supplement the rest of our retirement income in order to make sure that we have enough money coming in to be able to continue our standard of living. And really the goal in retirement is that our nest egg never drops in value. That is that the withdrawals we take are always made right back up from what the account earns that year. So when we talk about financial planning, right here, this financial house, we use that to illustrate the different levels of risk. High or the lowest risk right here is in the foundation. This is the mid-risk. This is the highest risk. So when we talk about retirement, we talk about investing your nest egg. That means what percentage, your asset allocation is what percentage you have in each of these categories. And we never even begin to talk about that until we have gone through your financial plan. We know exactly what we need to be pulling out annually in retirement. So we know how much your nest egg needs to earn in order to sustain that withdrawal without our nest egg balance decreasing. And the magic number there, let's say, is 5%. Let's say we've done your financial plan. We know you're going to be bringing in about this much in pension, Social Security. You spend this much. So maybe $20,000 is your deficit in the first year. The following year, that might be $22,500. The following year, 25 or 26, because your deficit would only increase because of I'm like, that should be at the top of everyone's head right now. Inflation doesn't happen, no. But because of inflation, so we want to know what rate of return our nest egg needs to earn in order to stay flat, even given our withdrawals. So once we've done all that work, we've done that financial plan, we know what rate of return, again, let's say for this example, that's 5% that we need to earn. That's our magic number, our average rate of return that's going to allow us to take those withdrawals without decreasing our portfolio balance. Only then do we start talking about how to invest the assets. Because the way that most large firms, and by that I mean Edward Jones, Fidelity, they're not USAA anymore, Charles Schwab, T. Rowe Price, they're going to determine your asset allocation based off of what you answer to one question, which I'll go over in a moment. But first, I'm going to talk a bit more about the financial house. So you've got your foundation, walls and roof. Again, the foundation is where your safe money is at. So that's going to be things like your savings account, a money market account, CDs. That would also be things like fixed annuities, fixed indexed annuities. Also, government securities, which are government bonds, e-bills or e-bonds, treasury notes, T-bills, T-notes. That is or state municipal bond funds, things like that. That's because the United States, the United States has never defaulted on a debt security. And because I'm limited on time tonight, we're going to assume that they never will. And so they're going to stay here in the foundation. So this is your ultra safe, less reward column here. Then in the walls, that's going to be assets and investments that are not totally correlated to the stock market. And that would be other bonds, so bonds that aren't issued by the government. Corporate bonds. If I have any TSP owners in the room, your G fund belongs here. The F fund belongs here. But that would be most bonds. What we tend to prefer here in the walls instead of bonds are blue chip, high dividend paying stocks. The reason that neither of these bonds or blue chip dividend stocks, the reason that those aren't totally correlated to the market has to do with how they produce income. So with a bond, regardless of what's going on in the stock market, if I've got a bond fund that's dropping in value, I'm still getting interest payments from it, regardless of if it's dipping or increasing. Same thing with a blue chip stock, high dividend stock. I think the best example for that, or the best way to describe that, is with an example, which was AT&T used to be called the widow's stock. Anybody remember that? They used to call AT&T the widow's stock because it was, honey, if I die, take every dollar we have and just put it into AT&T, right? I won't explain anything to you until I die, and then when you die, just take everything and put it in AT&T. If you were to do that with a $1 million portfolio, that would generate about $60,000 a year in income from dividends. My $1 million portfolio could drop to $880,000. It could increase to $1.1 million, and I'm still getting really the same $60,000 a year or $5,000 a month. Because that dividend income is not really correlated to what happens in the stock market. In fact, Target stock has been plummeting, and they recently increased their dividend by 20%. So that's sharing profits with their shareholders. It belongs here because, again, that dividend payment that I'm getting, that $5,000 a month, does not count on an increase in the stock price and isn't typically really hurt by a dip in the stock price. So that income is pretty stable, all other things considered, which is why it belongs in the walls. Because adversely, if they, let's say they designated a new widow stock and they picked Tesla, right? Honey, if I die, take every dollar and put it into Tesla stock and sell 10 shares a month. If I had a $1 million portfolio, then a couple weeks ago, that would be about $6,000 a month if I sold 10 Tesla shares. But 2 years ago, that could have been $7,500 a month. 3 years ago, that would have been $4,100 a month or $4,200. In a couple of years, that could be $51, $33. That income, if I was selling 10 shares of Tesla stock every month, that income is 100% correlated to what happens with the stock market or the volatility of Tesla stock, the share price of Tesla stock. Because Tesla is a growth stock, as are many or most of the tech stocks, those belong in the roof. They're not there to generate income, to share profits with their shareholders. They are going for maximum growth, which also is what makes them as volatile as they can be. So that's tech, that's AI, that's quite a bit of international funds or stocks. Also, and I'm not talking about gold and silver, but other precious metals. There's a lot of stuff that belongs there on the roof. And because we have more and more frequently been getting asked a certain question, we had to add this little piece to our financial house right here. Anyone know what that's for? Someone knows. I hear somebody say crypto. I swear, I thought, this would be, that's what it's for. Cryptocurrency. Really, this would probably be for Bitcoin, maybe Ethereum, the biggest names. What is a Doge coin would go here. If I bought the little, my goodness, crypto that like Elon Musk produced over here. These over here would probably also be for taking some of my nest egg and going to, I'm going to forget the name. You said what? I can't remember. What's the horse track? It's not the Kentucky Derby. What is it called? Colonial Downs, my goodness. Which I think they shut down, didn't they? They did? And there's another one they're opening, or working on opening. And I have clients in New Kent who have been talking for years about this casino that's being built. So I am from Kansas, where we have a full-blown casino with all the table games, all the slots that there's one about every 4 square miles, but that would be these, right? Also, what belongs up here are your cannabis stocks, what we call your up and smoke stocks. Or I had a lady that came in about a year ago, and she had an Edward Jones statement that was about 108 pages thick, and she said, whatever you do, don't look at pages 1 through 14, which I'm staring right at, so what am I going to do? She said, because that is my portfolio. And it was going down in smoke. But anyway, we're going to leave that out for right now, for tonight, because we're just going to talk about these 3 sections, your walls, foundation, your roof, because asset allocation, your financial house, is arguably the most important thing to get right and to keep right in order to have a successful retirement. And the one question that most of the large firms are going to ask you in order to determine your financial house or your asset allocation is, what is your, Meredith, gold star, what's your risk tolerance? Which you probably all have been asked at least twice at this point. I don't know, somewhere right in the middle. Statistically speaking, every single one of you, maybe not you in the white, but every single one of you in this room is going to answer that question exactly the same, somewhere right in the middle, or moderate. A couple of years ago, you probably said somewhere right in the middle, maybe leaning a bit more aggressive, but tomorrow you'd probably say somewhere in the middle, leaning a little bit more conservative. Or I will have one spouse that says I'm ultra aggressive and the other spouse says I'm ultra conservative. As a pair, you're down the middle. So statistically speaking, almost every single one of you in here, regardless of what your retirement income, your current income, your expenses in retirement look like, none of that matters but your risk tolerance. So you're going to get the same breakdown regardless of your plan. So when I say that we build the financial plan first, that is what drives the investment strategy, the financial house. It's because it has to be, because this is the most important thing to get right for your retirement, it has to be, or there has to be a lot more taken into account than just simply your risk tolerance. So a quick example here. If I had 2 couples that were, let's say both spouses are age 64 and everyone just retired and immediately kicked in their Social Security, of which they're receiving $40,000 a year. They're spending $60,000 a year. Couple A over here, right, 40,000, same Social Security, $40,000 a year, same expenses. And we'll say that couple A has saved $550,000 for retirement. That's their nest egg there. So we know that walking into retirement on day one, year one, we are short $20,000 a year. And regardless of the performance in the stock market, we're going to spend the same $60K. So for this couple, we probably want to have a nice chunk of this $550 here in the foundation to make sure that we can safely pull this $20,000 and we don't have to sell stock right now or in the height of the COVID crash. We want to have enough here that we can safely pull that out for a couple of years to wait out any sort of big market drops. Maybe for this couple, that's 45% of their total. And then to help generate some of that $20,000 annual deficit, we're going to put some money in the walls to get the income from dividends and so on. Maybe there we do about 20% of the total. And then we still need a nice chunk here in the roof because that's a pretty substantial withdrawal off of that total and for quite a long time. So I need to make sure that I'm getting maximum growth on a nice chunk of my assets. So the remainder goes here. All right, so couple B, we've got the same Social Security, same expenses, but couple B also has pension income of an additional $40,000 a year. And couple B has saved $1.2 million for retirement. So couple B is essentially saving money in retirement, bringing in $80,000, spending $60,000. So if I am, which this is very uncommon to save money in retirement, but if I am couple B over here and I'm saving $20,000 a year, I don't need to really have that protection on my assets. I'm likely never going to need to withdraw from my $1.2 million, maybe in about 15, 20 years because of inflation, or maybe for some long-term care costs, but it's going to be a very long time. I could have 100% up here on the roof if I wanted to, going into retirement. Now, have I ever seen anyone that looks anywhere close to this that wants 100% in the roof as they're approaching retirement? No, but maybe we do 75% in the roof. They still like that nice chunk in the foundation, that money that is safe, secure, they know is not going anywhere, regardless of what happens in the market. For simplicity's sake tonight, we're going to leave the wall. We might add in some walls money just to add some diversification, but I'm going to leave that out for now. Now, these two couples would probably, again, answer that risk tolerance question exactly the same, and so they would get the same breakdown, which for couple B is not the end of the world because they really have a lot of flexibility on how they design their financial house. But couple A's income, which most retirees, your income, what you spend, your standard of living, counts on your nest egg to some degree. So that would not work for this couple, a 50-50 break. Right? So again, a lot more taken to take into account than just your risk tolerance, which we can only really do from the full plan. Now, with our financial plan, we also go a bit deeper behind the scenes into 5 different subcategories or sub-plans that all start with an I here. With the time I have left, I'm going to go over what each one of these sort of means and an example or two of how they work. Number 1 is making sure that you've got a concrete income plan, and that is timing of Social Security. What makes the most sense? We can do that on paper by the numbers. We can figure out exactly the one If I start at 62, my spouse starts at 70, or if I start at 63, my spouse starts at 69, 64, 68. We can do every single different option and see which one has us with the most money at age 84 or 87. Now, is that the one that we're going to go with normally or almost never? No, we're not going to go with that. There's a lot of other factors that come into play, like mine and or my spouse's health. If one spouse has a significantly higher Social Security benefit than the other, or what your general feeling on the Social Security program is to begin with. But at least we can know, right, from the numbers what makes the most sense. Income planning is also pension planning. For any of you that are going to be the lucky lottery ticket winners of receiving a pension in retirement, you know, if you've gotten onto your benefits estimator onto the website, that there are 15 different options to select from. That is pension or military retirement. I can take the highest monthly payment, and when I die, so does it. Right? I get $5,000 a month, but when I pass away, no more pension. Or I can take $4,500 a month, and it continues for the rest of mine and my spouse's life, whoever lives longer, via a 100% survivorship. There's a 50% survivorship. There are these weird things called 10, 20-year pop-ups, certain lives. There's a lot of options there to take. Our financial plan, we can figure out which one makes the most sense, which a lot of that comes from doing what we call what-if planning, which is a part of survivorship planning. You know, what if I take the highest monthly payment, the $5,000 a month, and I die in 2 years, and my spouse lives another 25, 30 years with no $5,000 a month that we were expecting? If that would be entirely detrimental, well, what if I took the 50% survivorship option and I died in 2 years or 7 years or 13 years, and then my spouse received half of that monthly payment and lived another 50? All of those different plans so that we can ensure that we're making the right decision before we sign off on that paperwork. That's a pretty daunting form to turn in without having really done the back work on it. Income planning is also taking income from your investments. The next I, investment planning, sort of easy. I already went over it. That's your financial house. And not only to get that set up correctly right now, but to make sure that it stays accurate, correct, appropriate via rebalancing, reallocating as necessary. I might look like this at 64, but 15 years from now, this couple may be 60-40. They may be 90-10. Their objectives, their goals, that can change over time. So making sure that we keep the balance accurate as well. And then just as important as starting with and maintaining the right percentages in each of these categories is having the right investments in them as well. If I am couple A over here, I'm counting on this nest egg to generate this $20,000 a year for my income to meet my expenses. I don't need to have my 45% in one of today's CDs that pays 0.00 nothing, right? Also, if I'm over here, again, I will likely never or not for a very, very, very long time need to pull out money from my nest egg. So I don't need to have this 25% of my total, which in this case would be 120, 240, about $320,000 in a fixed annuity that has one of these lifetime income benefit riders attached to it that costs me 1% a year to keep or to have, because I don't need to generate that income. Over here, that could make some sense. Over here, it makes none. Or if I am, we'll say couple B, and I have 75% of my $1.2 million in the roof, I don't need to have all of that in an international mutual fund or a split between Apple and Amazon stock. So again, the right percentages, but the right investments as well. The next I there is insurance planning. what we do in our office is just look at all the insurances that we have. Do we have too much somewhere? Do we have too little? A thorough analysis of existing insurance and potentially necessary additional insurance, but typically in retirement, you're all right with not having a whole lot of life insurance, especially if you have paid off your mortgage. I don't have one of these pensions that's dying with me problems. Most of you are going to probably be okay without a whole lot of insurance, but you could come into the office and say, I just, a few months ago, started my pension. It is $5,000 a month. It has no survivorship benefit. And my spouse would be left with, instead of, between pension and Social Security, instead of $9,000 a month, they're going to be left with $2,700 a month. And that's not going to, maybe then you might need to look at some term insurance, and we can ladder that so that you have the most insurance the younger you are, and it not only do your premiums, but your insurance amount lessen the older you get because you have to insure for less years. Insurance also, if I am retiring at 64, 63, 2, 1, I need to make sure that in my plan I have accounted for that extra expense I get to pay until 65. So retiring at 62 when I have $60,000 a year in expenses is one thing, but I have to account for the cost of health insurance. So I need to make sure that I'm able to pay more like $72,000 a year in expenses before 65 when it would drop to my normal rate. If any of you have gone through looking at health insurance costs after retirement, if you haven't, just don't. That is a jumbo ticket item, and a what I would call giant or maximum ticket item would be long-term care insurance, which is probably the one of, if not the main concern for people nearing or in retirement, is the cost of long-term care and the rising of those costs. How am I going to be able to pay for it? Do I need to get long-term care insurance, which is not always yes. If I'm couple B, I would probably say, no way do we need long-term care insurance. We'd be fine to self-insure. If I need to go into long-term care in 15 years, I'm going to have almost $3 million to do that with. Over here, it's more of a concern. So how can we make sure that we have some sort of a long-term care buffer? That's not always going out and purchasing the straight-up long-term care insurance. There are a bunch of different options in the marketplace for what are called, there are some products called hybrid or combo products, which are used for either a long-term care benefit or a death benefit, depending on which one I end up needing. There are also products that have long-term care buffers or benefits built into them, investment products that we could look at. But I know long-term care, that's a big issue for retirees. It's a big thing that we look at as well in our plans. Part of also the what-if planning, right? What if I am couple B and my spouse goes into long-term care at 73 and spends $150,000 a year for 6, 7, 8 years, and then passes and I live for another 15 with $750,000 less than what we expected I would have. Part of the what if, the survivorship planning. Income tax planning, that is probably one of the most difficult eyes to look after on your own, and one of the most crucial to determine the projection of your retirement. I have an example for that one because we had a couple come in. This is almost 2 years ago now. I have to make sure I get this right. So they came in about 2 years ago. At that time, the husband was 82 years old. He was 82 and his wife was 63. We put their information into our financial plan. If they continued doing what they had been, stop it, for the last 5 years, they were going to run out of money in about 15. And he was totally fine with that, right? He was totally fine. I don't care, whatever. She, on the other hand, steam coming out of her ears, was not okay with that. She was extremely concerned because in 15 years, that would mean she'd be out of money at 77, 78. What we noticed right away was how much they were spending every year in income taxes. They had a deficit of about $3,000 a month, and they were pulling that entire $3,000 plus taxes from his traditional IRAs, which means they were pulling $3,000 plus, I think it was about 33. They were pulling out about $4,000 a month, about $50,000 a year from his traditional IRA money. They had Roth IRA money. They had a couple of non-retirement accounts, but they had been told to never draw. I don't know when they were told this, but to not touch your Roth IRAs until all of your traditional IRA money was gone. Deplete that first and then touch your Roth IRAs, which in theory sounds great unless it costs you money every year to work like that. Also, they had, like I said, non-retirement accounts, but they never pulled from those because if they did, they'd have to sell stocks that had quite a bit of capital gains, and they didn't want to pay more money in taxes. Again, in theory. But what we did was, also, when they were pulling out that $50,000 a year that was all taxable, all added on to the total taxable income, what it was doing was pushing him into, I believe, the third Medicare penalty phase. Right, so in retirement, once you are in the stage where you are in the Medicare age, if you make too much, you have to pay more money a month in Medicare than your peers. And by make too much, that does include having to take a mandated IRS withdrawal from your retirement accounts. That can be up to an additional $600 a month per person. In this case, for this couple, it was an additional about $450 a month for the husband. So that was adding on almost $5,000 a year in that penalty, but because they were drawing all of the money from the traditional IRAs as well, they were kicked up into another tax bracket. It was creating a windfall of issues. What we did was figured out a strategy where what they do now is for the first half of the year, they pull that $3,000 plus taxes from his traditional IRA, but then we stop. And in the third quarter of every year, we pull from the Roth IRAs, and in the fourth quarter of every year, we pull from the non-retirement accounts. And in doing so, it's a savings of about $13,000, $14,000 a year. No more Medicare penalty. They're not in that box anymore, and it kicked them into the lower tax phase or bracket that they should have been in anyway, which made it so that the assets are going to last until she is in her early 90s now. It added 14, 15 years to the plan, which, again, is a huge, huge deal. So income tax planning, again, likely the most important. That's the bucket strategy, your withdrawal strategy in retirement, and how much I pull from each one of these different tax-structured buckets. Also, when I'm working, which tax-structured buckets should I be saving into? The pre-post-retire or pre-post-tax Roth IRA, 401 or Roth IRA, traditional IRA, Roth 401k, traditional 401k. What makes the most sense? Which for most of you, you're in your highest income, highest earning years you've ever been in. Right? You typically only go upwards. So it's typically the best option for you to continue getting all of your money in the traditional, in the pre-tax plan, and getting your maximum deductions, because I'm in the 33% bracket right now. When I go to retire, I'm in the 6% bracket. I can take that same money that I got a deduction at 33% on, and I can convert it into a Roth at 8 or 10%. So I get a deduction at 33, and I can convert it at 10. That's Roth conversion strategizing. And typically that's the way that it works, is that when you are in your final working years, which by that I mean your final 5 working years, let me keep getting my maximum deductions. I can turn around when I retire and I can convert those into a Roth IRA. That's a Roth conversion. Convert those, paying much less taxes than I would have if I would have put them in a Roth in the years I was still working. So Roth conversion strategizing is huge. Oh, before I forget, I just recently added this video that I believe is the best depiction of tax planning, or just taxes in general. Everyone in here has played Monopoly at some point, right? So you remember that luxury tax you had to pay? All right.
Oh my gosh. Where's all your money gone, Daddy? Taxes. 9, 10, 11. Let me fix my houses. But it's okay. It's part of the game. It's not. It's not fun. It's not fun to what? It's the worst part of the game. Is what? Taxes.
That's what we all look like on April 15th, 13th, or October. All right. So inheritance planning, the final I there, that is, for some of you, pretty simple. Making sure I've got my I's dotted, T's crossed. I have my will, my living will, my power of attorney, my advanced medical directive. For some of you, that might be making sure that we have got, well, transfer on death deed. So with your property, if any of you have parents or friends whose parent you've seen anyone go through probate on real estate, it is the probate in general is the worst, but probate with real estate is tenfold the worst. If you were probate on real estate, I mean, a year, 2, 3, 4, 5 years, 1, 2, 3, 4, 10, 11, $12,000, 20, depending on the property, it is massive. So instead of having your property go through probate, there's a little thing called a transfer on death deed. That is, if you Google transfer on death deed Virginia, it's about a 1.5-page form. It takes about 15 minutes to complete. Take it to the bank, get it notarized, file it at, I never remember the office, city clerk, recorder, circuit, something. You know what I'm talking about. Take it there, costs $15, $20 to file, and that avoids probate on your property. That details exactly what I want to have happen with my property upon my death. Not only my death, but on the death of all owners on the original deed. So a transfer on death deed would say at the passing of all original deed owners, it goes 100% to this person, or 50% and 50% to these people, and it stays out of the probate process. Again, that's a transfer on death deed. Also, because I far too frequently see folks come in without what is called a payable on death designation, because this is something specific to a bank account. And for some reason, some smaller credit unions force you to establish a payable on death designation. What that is a beneficiary for a bank account. But Bank of America, Capital One, they don't make you do it. If you do not have a payable on death designee on your bank account, that's going through probate. I had a lady that came in some years ago, and her mother had what she called, how did she put it? She said, was a squirrel hiding all of her nuts in different trees. She had, I think, 22 different bank and credit union accounts and did not have a payable on death designated on any of them. What was about $630,000 squirreled away after legal fees, probate, all of that cost. She ended up with about $510,000, which is still obviously a good amount of money from savings accounts, but it costs over 6 figures because her mother did not have a payable on death designee on any of those accounts. And really, this money is the quickest and easiest money to access in the event of your passing. So when you think about things like funeral expenses, the beneficiary or the payable on death designee can walk into the bank with your certificate of death and get a check right then and there, or an electronic transfer right then and there, and pay for those funeral expenses like that, and not have to go through probate for months, years, thousands of dollars. Just do that on your bank account. Also, when we talk about beneficiaries, transfer on death, the next step further would be looking at, do we need a trust? Which, by the way, if any of you currently have a trust that includes your property in your bank accounts, what you have right now supersedes this. So you can just erase the last minute and a half. But for those of you who do not have a trust, and maybe we are wanting to look at whether or not we need to implement one, that would be if me and my spouse both have children from previous marriages and I want my assets to go to my children, my spouse wants theirs to go to their children, I might look at a trust for something like that. Or if I have a child or a grandchild with special needs, there are trusts specific for that. If I've got a lot of rental properties, a lot of real estate, there are trusts specific for that. Or if I've got one son, he's 25 years old, and I hate the thought of him inheriting $1.5 million overnight, like that. Trusts can make very specific how the heirs, the beneficiaries, are able to withdraw those funds. Right, so maybe that person, that son or daughter, son, can take that money out year by year, 2% maximum, unless it's for a proven education or a medical reason. So some people like trust just for that, so I can have that authority even when I'm gone. Right, but we'll look at all of that. These 5 I's, which is also, so these dinner events, the reason we have these, and I believe it dates back to my dad's time with Mass Mutual, the first large firm he worked for, when he switched to individual finance from corporate. So Mass Mutual's marketing strategy was to cold call until you run out of breath, you're blue in the face. It was the worst thing ever. And to bother the you-know-what out of everyone you know for leads, he could not stand it. Thank goodness he does not make any of us do that. So we don't ever speak to folks that have not expressed at least some interest in hearing what we have to say, i.e. responding to our invitation. But what we offer after these dinner events, these seminars, is a free consultation. It takes 45 minutes to an hour. We do still offer them virtually if that's what you prefer, but most of them are done in the office, right on Twin Hickory, right around the Knuckles area. Right, that's where our office is here. So those take 45 minutes to an hour. What we will do is go through your 5 I's here and see if you have any sort of red flags. There are some of you that will come in for a first appointment or consultation, and there's really not a whole lot that we can do to assist you or to bring benefit to your plan, your situation. I had a lady come in, this was in August of 2021, so almost a year ago. She was 76 years old. All I could do for her was point out the fact that she was gifting the IRS an extra about $11,000 a year. There was really nothing else I could help her with, but what I noticed when I looked at her tax return right away, this woman, she was a beacon of frugality. She had worked for VRS for about 43 years. She had a first job to her last job. She retired at 74 or 5. She had a pension of about $4,200 a month. She was spending none of that. She was barely even spending all of her Social Security, right? So she was gifting a lot of money every month, every year to her alma mater, to her church. She was giving, between the two of them, about $50,000 a year. And what she was doing was having Vanguard. At the beginning of every year, she was calling up Vanguard like the great little IRS student that she was and saying, this is how much my RMD is this year. Maybe that was $58,000. Please take taxes out, 24% for federal, 6% for state, and send it to my bank account. And then she was writing her checks to her church and her school all year long. If she would have instead said send that money from Vanguard directly into the church's deposit account and the school's deposit account, she wouldn't have had to pay taxes. Neither would the school and church. That is called a QCD, a qualified charitable distribution, which is only applicable with RMD money. But right then and there, that saved, like I said, almost 12 grand a year in taxes. The key there, the trick there, it cannot pass through the IRA owner's fingertips or their bank account. It has to go direct from institution to 501c3. So there will be folks that have little things like that we can spot in 30, 45 seconds. Something like if you should be doing Roth conversions right now, that takes about a minute to decipher from your tax return. Or if you should be switching out, like if your financial house is all out of whack. It takes us about a minute to figure that out. It takes us a minute or two to see how much you're paying for your current investment portfolio. But regardless, I can guarantee you will not walk away with nothing, even if it is just a tip, trick, tweak here and there. But there will be quite a few of the folks who set meetings who we do see you have a few more prominent issues in some of these eyes. We'll talk about maybe some solutions we could provide for it. If you agree, we'll set up a second meeting. Also free during that second meeting, we will go over a rough draft financial plan of ours that we've created for you based off of your information. So we'll give you a rough draft of those financial plan snapshots, a rough draft example of how we may allocate your assets or recommend to allocate your assets, and exactly how much it would cost to do so. And some of you may end up becoming clients, but again, you will not leave with nothing. So we would love to see you in there. If you do set up a meeting, I just ask 2 questions of you. To keep our offices as efficient as possible. Jan back there, a beam of light in this dark world, is amazing. So I love to help her keep her time as efficient as possible. If you do set an appointment, I know you might not know your schedule for the next week or two. If you just stick something on, it is so much easier for us to reschedule an already made appointment than it is to try to play phone tag to get it on there in the first place. Also, and I know this probably applies to nobody in here, but there's a statistic that says that when you wake up in the morning, you may be able to recall about 40-50% of what I just talked about. None of you, of course. If you wait a week, you might be able to remember about 15-20%, but if you do not have a meeting with us for over 2.5, 3 weeks, we're going to call you to remind you of your appointment, and you're going to hang up because you think we're spam. I've never heard of Carlson Financial or Red Salt. So the sooner the better while it's fresh. We would greatly appreciate that. I am going to stick around a bit back here for a few minutes should anyone have any questions, but I believe they're probably ready with the food. So that's going to be it for me. I hope you all enjoy your food. I appreciate your attention and have a good rest of your night. Right. Thank you.
In just a minute, Jan and I will come around and grab those evaluation forms from you. But again, thank you for coming out. We look forward to seeing you all again soon.